Welcome to Deconstruct, a podcast from The Real Deal. I'm Lila Burke.
And I'm Hannah Kramer.
We have a lot of real estate news for you this week.
We do. We have an update on the Omnibuild HFC scandal. We have a real estate lawsuit between a top brokerage and a top art house. And then we'll round up some of the most important and interesting deals you need to know about in New York this week.
And for our main story, we'll have top broker Frances Katzen on to talk about spring selling season.
Let's get started.
First, we'll take you through some New York headlines. As usual, we have some crime drama.
What's happening this week?
Well, we have guilty pleas in the Omnibuild HFZ fraud saga. And executives who were staring down grand larceny and other felonies, they're getting off with misdemeanors and no jail time.
Lucky them. Walk us back and remind us what happened here.
So the two men in question are a former CEO and accountant at construction firm Omnibuild. They were indicted in 2024 with accusations that they artificially inflated invoices on a Highline project called XI.
Right, and inflated those invoices just to bring in more money?
Actually, it went a little deeper than that. Prosecutors say that the two men, former co-CEO John Mingione and accountant Kevin Stewart, were trying to make it look like construction was further along on the project than it actually was in order to get the lender to release $6.5 million. And prosecutors say that Omnibuild needed that money to cover shortfalls from other fraud on the project. They say that HFC capital exec Nir Mir was diverting funds from XI to other developments and also to personal accounts.
Okay, going back to these two executives, they are taking plea deals. What do they face now?
Mingione, the former CEO, he'll have to pay $20,000 and do 100 hours of community service. For Stewart, the accountant, that's going to be $1,000 and 25 hours of community service.
That doesn't seem so bad. What about Nir Mir?
Prosecutors are saying that Mir was kind of the mastermind behind this whole scheme, but he's pleaded not guilty. He was released from Rikers last year and since then has been on house arrest. He is actually in court today, and we have a reporter who will be reporting on that.
So we'll have an update on Nir's latest, perhaps by the time this podcast is published. And in a couple of minutes, we'll take you through some of those top deals that you need to know in New York this week. But first, I want to take you through a little bit of deal drama. And this is something that we see happen pretty often in lawsuit stories that we cover. A big deal goes down, and then a bunch of different people fight it out for credit and therefore cash on the deal.
What deal are we talking about this week?
So back in October, Sotheby's, the art house, not the residential real estate brokerage, sold its former headquarters at 1334 York Avenue to Weill Cornell Medicine for $510 million. Weill Cornell was already the largest tenant in the office building because Sotheby's had purchased the Brewer building and a building out in Long Island City and was in the process of moving its headquarters there.
Okay, sounds fine. What happened?
Well, last week, Cushman Wakefield, which is one of the largest commercial brokerages in the city, sued Sotheby's, saying they basically stiffed them on a commission in the deal.
Okay, what do the brokers say happened?
So going back a little bit, Cushman Wakefield did a 200,000 square foot office lease at 1334 York back in 2023. They brought in what became the biggest tenant, Weill Cornell. And they say that they had a deal with Sotheby's that if Weill Cornell decided to buy the whole building, they would get a 2% split.
Okay, so I'm guessing they didn't get that.
They did not. And we're talking about a big commission here. On a $510 million asset sale, 2% is over $10 million. Weill Cornell and Sotheby's cut the deal with brokers from JLL and CBRE, respectively. And Cushman didn't hear about it until we did, until it was in the news.
Oof, okay, so that's gotta hurt.
Yeah, especially for the office brokers who cut that big lease. Right? Now, we don't have the exact numbers on what commission they would have made on the Weill Cornell lease, but I think it's safe to say it's less than the $10 million commission that they would have gotten on the asset sale.
What does Sotheby's have to say about all this?
They say that the lawsuit is meritless and that they'll defend themselves. But for us, it's really just interesting to see how these big firms, jockey for credit and therefore for cash in any of these major deals. Like, who really gets credit for this deal, right? Could the deal still have gone down if Cushman hadn't brought Weill Cornell in as an office tenant before they were a purchaser?
I don't know.
I don't either. But now everybody gets to pay their lawyers a ton of money to have a judge tell us, which is more expensive for them, but a lot more fun for us.
Definitely. Lastly, in New York, we wanted to give you a little deal roundup.
Tell me what you got.
Well, for $380 million, we have 575 Fifth Avenue, which is off 47th Street. It is a 40-story office tower, currently in contract to Sovereign Partners, run by Cyrus and Darius Sakai.
Okay, is $380 million a good price?
I mean, it's $5 million less than MetLife bought the building for in 2005.
I'm not going to call that a good price. What else you got?
Well, okay, so Rhythm Capital is lining up a $282 million refinancing loan on its 1325 6th Avenue. That's a 34-story Midtown office tower. It's their first deal since they bought Paramount Group in December for $1.6 billion. Then for $40 million, we have prolific dealmaker David Werner, who purchased a Times Square Hell's Kitchen office building on 43rd Street between 8th and 9th Avenues. And this was a bargain. The last owner paid about 3 times as much for the building, $131 million. And Werner's been pretty big in the office to residential conversion game, so that's probably what we're looking at here.
Okay, let's get into our main story for the week. It is springtime here in New York City, which means it is spring selling season.
That's right. And the residential markets are in a bit of a strange place right now. We wanted to bring on an expert to tell us a little bit about where the market is sitting, what's happening, and what both folks in the industry and buyers and sellers should know about it. To that end, we have Frances Katzen here with us.
Frances, welcome to the pod.
Nice to be here. Thank you.
So as we move into spring, how would you describe the luxury market right now?
I would say it's not euphoric. It's busy, but only for decisive movement. People know what they want. They know what they don't want. And identifying it, if they find it, they'll do it, especially if sellers have started to yield to the market more of the buyer.
And what do people want, right? What's hot?
Well, there's not very much new development right now. So the first quarter really has only 81 units out in the market, which means there's a big supply issue. So it then becomes not about buying new development, but rather about buying something that's going to really rally. 1122 Madison's pretty hot. That has taken off. I've shown that building. It's amazing. So that's a very specific niche. I would say One Highline has done well. I would say that people are very particular. 53 West 53rd has rallied in a way that we haven't seen in a while. I think that the market itself is cost prohibitive to do renovation. So the product has to match, and that means price. It means location. It means the buyers are very decisive. They know what they don't want. They know what they want. Spring market's that.
So if there are neighborhoods in particular, new development as sort of an asset class seems to be what's hot.
Yep.
Are there particular neighborhoods or even pockets of neighborhoods that are just bursting?
I would have to say we have seen some staggering numbers in the West Village, unlike anything we even expected, especially based on timing. The timing of those numbers, even last summer, was stratospheric. Unreal numbers, 126 million, 80 million. It was another game completely.
And what are you seeing as far as asset classes, condos versus co-ops?
We've seen a rally, but I'm going to say the big C is back, co-op, because for 3 years, it was absolutely decimated. People did not have the income, or their stocks were not rallying. Most people were buying with the interest accrued on these principal investments, and equity markets were not great. So you would see the Olshan report go out and go, we've seen 36 condos, 0 co-ops, and 2 townhouses. And last week, we were up 37 contracts signed. 11 of them were co-op and 2 were townhouses. So I'm like, yeah, baby, we're back.
What do you think has caused that change for co-ops?
People are making money or were making money pretty strongly and consistently the end of last year. It rallied. And I think people were feeling somewhat excited about the fact that they could get more bang for buck. The co-op market really yielded to the lack of demand, opening up a whole segment of value for people who couldn't afford to pay up for small space like a condo was offering in these more demanding areas. There's not enough supply. So it's driving up and holding demand, offsetting and pricing out some people who really want to get back in. And that's in conjunction with the rate change. As the rates started to come down, people could stop renting and actually get back in.
So what's it like inside the new development that is on the market? How competitive would you say those buys are?
I work in new development, and we are competing with all of our competitors, and it really comes down to value. And value can be understood in two ways. Obviously, price, or how much space you're getting and how much is offered with that space, which is why we've seen some of our projects really rally, and they are now because you're getting so much.
One of the things that we hear is that buyers at the sort of super luxury level, they're not as susceptible to rates. So
Correct.
Tell us kind of how that's impacting your potential buyers right now, whether it's elevated rates or that doesn't matter. It's more about their stock portfolio. What are you seeing there?
I would say that there are two camps of thought. Most of the ultra luxury, which is over 10 million, not the luxury entry, which is 4 million plus. That 10 million plus, they are not even concerned about any type of financing. So it is a discretionary, decisive choice. It is not predicated on rates. The luxury market have the biggest jump because they're starting to see this sort of widened gap. The 3-bedroom markets are no longer 4 and 5. They're now 7 to 10. So it's a big spread. That rate matters. And I always am sort of shocked when I studied the amount of change in contract pricing and contracts. There was a 58.3% reduction between the 4 and 5 million segment in the second and third quarter of last year. I couldn't believe it. What that told me is they are totally stretched and they really want to keep their quality of life looking good, keeping up with the Joneses, but also want more space. And it's priced out. There's a gap. Mm-hmm. That was interesting to me.
So we want to talk about inventory. We've talked already about there being sort of an inventory crisis,
Big time.
Real lack of new development.
Yep.
Where is that hitting the hardest? Maybe this $4 or $5 million sector?
No, everywhere. Mm-hmm. I disagree with it being a certain segment. I think when you have discretionary income, you're less dependent on the mood swings because there's off-market, there are timing that's much more loose. It's the entry through to luxury that are struggling because it is limited and nobody wants to give up that amazing rate they once had. So they're really struggling with size and value. But I will say this, there is the idea that you can refinance, and we are seeing 10-year and 7-year at 5.25 to 5.5, which is a huge adjustment from 8% when we saw it go up in September of 2002. To me, I think there's an inherent value in getting in irrespective of whether or not that rate is great. Because ultimately, the commodity of space is what creates inherent value, in my opinion, as long as it's a good space in terms of what makes the market sing, location, doorman or not, view, light, all that stuff. But those 3-bedroom, that kind of play is the play for long-term value.
We're seeing a lot of geopolitical pressure and economic uncertainty. I'm curious if you think those are affecting buyers and sellers in any way?
It's so bizarre. Normally, I would say absolutely, but it's actually going counterintuitively the other way. I was concerned and have been concerned about the potential implication of tax ramifications, which includes a 9.5% hit for real estate, which is one way to fizzle that. The other potential hit is the 1% mansion tax. I mean, you've got two evils. It's like, which way do you go? And what are the implications? And I'm wondering if that's part of what's driving people to buy now, is that they are trying to be ahead of it. That being said, I have no idea if that's going to formally take shape. And there's a conversation that the legislation can be pulled and the money can be pulled from different ways and structures that they have.
Right. And so we've been talking a lot here about whether there's going to be or has been so far a Mamdani effect, wealthier buyers fleeing the city. So it seems like that's not happening so far. What's your impression of that? And do you think that there's something that could make that happen in the future?
Obviously, I think if he starts creating what I hope will not be the case, a much less capitalistic environment, I think you're going to see fallout. However, I am amazed because during his run-up, that's when the $126 million and $80 million trades were happening. So if people were going to pull out, that was probably the time I was going to watch. I have still seen the highest bonus payout in 3 decades, which has allocated very actively into real estate. People are trying to diversify their asset. They are not comfortable staying in the equity markets. They're trying to get into real estate. The sellers have come down to meet the market more, and new development is scarce. So if it's an investor and it's not an end user, you can still buy the imperfect units and cash cow them because the rental market has been so robust. So it's a vehicle, and New York is still the play for allocation from all over the globe, tax-wise, and getting money out of their countries.
I want to ask about resales. A couple months ago, we did a story that was tracking resale specifically on Billionaires Row and showing how some things have increased and others have not, right? So, I just would love to know what you're seeing. Like, the new development market is very limited. At the same time, in the last few years, we've seen prices go to astronomical levels that we had never seen before, right? So on the resale side, what are you seeing?
The resale side has been a very different market than new construction. By simple virtue, it's no longer the new kid on the block. It's not shiny. It's not as sexy. The issue that you're running into is depending on when they bought will determine what they're willing to release it for. So people who get in at the end are paying the most because they've got the least risk and the most to pay up for. The people that get in early have taken the risk. So the pricing of the resale can really impact what you're competing with because it's a lose battle. Some of the people who paid later on are going, oh my gosh, I'm now losing. And that tends to be a theme. That's why I've always said you never want to be buying when everybody else is buying. You want to buy against the market. That's where negotiability is and value. And the resale market has become a huge value play at the moment. We are busy. My listings are moving. We have 8 contracts out this week. That's probably why I look a little stressed because you never know how it's going to go. But that's the kind of movement because there's a value proposition against the newer construction. And if you price it appropriately and not greedily, people recognize it.
What do you think has caused that shift between pricing greedily, I liked your wording there, and appropriately? Because we were seeing things sit on the market, right?
Yeah. I think that there's also a fear factor that runs behind that. They don't want to be renegotiated below their threshold. So if the idea is put a little fat on the deal, you have room to play with. The problem is because there's so much access to information, everybody knows what everybody's doing. And so they're going to formulate an offer predicated on the most recent sale or closing, not what you think it's worth because you put waterworks finishes into them.
Well, for the consumers listening, what's happening behind the scenes that you think they should know about, buyers and sellers who are maybe not as in the know?
I think you have to really trust your gut. That's such an odd thing to say. But I often say to people, when you are not versed on product, but you like a location and you are drawn to certain things, trust it. Because that is what speaks to you and will ultimately drive you to feel good about what you're doing. It's sort of like trying to retrofit what you should like, but what actually works. The biggest value for buyers right now is avoiding what you shouldn't buy, meaning understanding what's not going to work for you. That's the value. And that's the homework of actually going out and walking neighborhoods and walking buildings and looking at the monthlies and saying, is this the best I can do with my money?
Final question before we let you go. And I'm really going to ask you sort of 2 questions in one. One, as this season gets really busy, what do you do to sort of prepare for it? And then 2, one of the things that we see as we here at The Real Deal sort of track the comings and goings of the super wealthy, is that, folks do certainly come here to New York City and many people continue to buy, but people also sort of scatter around the world a lot of the time in the summer. Do you chase those folks to the Hamptons or Monaco as they kind of go off on their travails?
I think timing is as important as pricing. And so, no, I'm the opposite. I actually don't think when it comes time for summer, depending on which market, obviously Hamptons is different than a hot inner city like New York or Rome or wherever. I don't think people really want to go into that at that time. If there's momentum, I play it out. If it's quiet, I take it off. I don't want my products sitting through the summer. No one's around. They're not focused. They want time with their families. They want to recalibrate. They come back. They're back at their desk after Labor Day. Now we begin again. Now we're starting to get our bonus numbers. And that's when they start seeing what's happening with the market, what's traded, what's sat, and then they go in. I don't chase people overseas. I let them come here. European buyers by nature are quite conservative. They come to their destination. They'll look at it 50 different ways and put it down and think about it anyway. Unlike an American that will pick it up and say, I love it, I'll take two.
Frances, thank you so much.
Thank you so much for having me. It was fun.
Good. All right. Before we go, we're going to take you on a brief tour of our national headlines from this week, starting in South Florida. I have to shout out this incredible story that our reporter, Frank Alvarado, has been covering really for several years. And he published kind of a big look at the whole drama this week.
Yeah, tell me about it.
So for years, Frank has tracked the terrible, fascinating story about the death of Miami developer Sergio Pino, who founded Century Home Builders Group.
What happened to Sergio?
Well, for the last few years of his life, Sergio Pino was involved in a very gnarly divorce from his wife, Tatiana Pino. So nasty, in fact, that he allegedly orchestrated a plot to have her killed rather than split up the real estate empire that he had built.
Oh my God.
I know. Tatiana was the victim of a hit and run. She had a man break into her home and chase her through it with a gun. It's all really insane stuff. And the FBI got involved. And in July of 2024, as FBI agents descended on Sergio Pino's home to arrest him, he took his own life.
Oh my God.
Yeah. But for us, this is kind of just the beginning of the story, because for the last several years, there has been a battle going on for control of his assets.
Okay. Who's involved with that?
Well, Tatiana Pino, for one, she owned 50% of the company, and upon her husband's death, she became president. She was in battles with Carlos Pino, his brother, and there were all these disputes between Tatiana, Carlos, Tatiana's children with Sergio, Sergio's children from a first marriage. A lot of those battles have been resolved, but there's an ongoing conflict with Sergio's alleged mistress and several other folks. So you really have to read the full story to get the whole picture. It is online now. I highly encourage you to take a look.
I definitely will be.
Now I want to go international. Let's talk about Amancio Ortega. This is the Spanish billionaire who founded Zara and has been on a real estate shopping spree.
Ooh, okay. So the real estate version of fast fashion?
Well, he certainly makes deals fast, but the real estate itself is not cheap. Ortega, through his real estate investment family office, Ponte Gadea, is now the largest private individual owner of real estate, not just in one city or one country, but in the world.
Wow. Okay, so how much real estate does he own?
Something like $25 billion worth. He owns more than 200 properties across 13 countries. Recent buys include the $850 million all-cash purchase of Vancouver's Canada Post building. Last summer, we covered a lot of his deals in South Florida to the tune of something like $440 million. And he makes all of these deals very fast. He pays all cash, which means he can win deals sometimes even if he's not the highest bidder.
Okay, where is all this cash coming from? From Zara?
It's all his. Yeah, Forbes calculated that Inditex, which is the parent company of Zara and several other fashion brands, has made him something like $28 billion, that's billion with a B, dollars in dividends just since it premiered on the Madrid Stock Exchange in the early 2000s.
Okay, how much money does Ortega specifically have?
When I last checked on Tuesday night, Forbes estimated $148 billion, which slots him in as the 10th richest person in the world, right below Warren Buffett, just above Rob Walton from Walmart.
Okay, so why is he doing all of this? He just loves real estate?
I mean, who doesn't love real estate? But no, he's 90 years old and he's not buying mansions to enjoy them. He's buying office buildings and retail properties and warehouses. He's doing it for the most important reason that anyone does anything in real estate, which is to make money and avoid taxes. In Spain, cash that's sitting in a bank account is a taxable liability, but he can avoid that tax if the money is tied up in a business asset like a telecom company or a solar farm or real estate. He is also able to avoid Spain's 30% top dividend tax bracket because of the way that he owns his Inditex stock through Ponte Gadea rather than individually.
Okay, well, happy tax season to him.
And to all of you. That's all we have this week, folks.
Thanks for joining us. Listen in next week.
See you soon.